Hello and welcome to This is Property. You're with John Pidgeon and Rachelle Kroon, my lovely co-host. New on the ground, Rach?
I am.
Today we're talking about the process of upsizing our own home or a home and how to use the equity in the current home to move to the next home. And we're talking about bridging loans, which some people have had bad experiences with. So we're going to talk about the pros and cons of those, aren't we?
Yeah, it's a very emotional thing by upsizing your home. Like we always talk about it from a financial perspective and, you know, what are the numbers? But it's a really big thing that people are deciding, which is upsizing their home and moving.
Yeah.
You know, you're uprooting your family.
Absolutely. And it may be only the one chance you do it in your life. So you want to make sure it's a winner. So we'll unpack this. Let's get into it. So you're going to sort of take the lead on this, I reckon, because you've done the due diligence on the finance side of things, and you've got a client scenario, or you've had many client scenarios over the journey that have gone through this.
Yeah. Well, I put a few client scenarios together when we discussed we were going to do upsizing. I put a couple together that I think illustrates the different ways that people have upsized their home. So there's one part of it which is the numbers. So, you know, what are the numbers? And I think you've got to be really comfortable with what you're going to end up with. So if you're going to upsize your home, and I'm just going to use these numbers. Let's say you're upsizing your home. You've got an $800,000 home now, and you're going to move to $1 million property. Your mortgage is going to increase not by $200,000, but by probably more like $250,000 or $280,000 because of the costs of changeover, agents' fees, stamp duty. And at the end of the day, you need to be comfortable with that mortgage being at that bigger level at the end. But I think where most of the anxiety comes for people when they are upsizing their home or side-sizing or doing something about moving their home is the actual process involved. Yeah. And I think the process is the daunting part. Do I buy before I sell? Do I sell and then buy? And what is bridging and can I do it?
Cart
is it risky?
Before the horse or horse before the cart? Which one usually leads? Yeah. From I suppose, a strategist point of view, it's really important to understand the cash flow requirements, isn't it? So if we strip this right back, we say, well, finance or cash flow 101 is know what's coming in and out in your life. And I'm sure you guys, as mortgage brokers, you're stating the obvious to people, but they come along to you and they maybe don't even know what they're saving or what their cash flow situation looks like. So it's really understanding that first of all.
Yeah, and I think people know what they want. So, you know, if you're upsizing because you want an extra bedroom or you want to get closer to your children's school or you want to get closer to the beach, which is a big one around us, you know what you want. And generally people know the level they're going to have to go to purchase price-wise to be able to, I guess, to get what they desire. But the big thing that people need to know is, can I afford that bigger mortgage and what am I risking when I do that?
Yeah. So I think the first things that people need to get in order is, what am I saving right now? What's my situation right now? I've got this mortgage. If I've got an $800K property and my mortgage is, I don't know, $400K.
Yep.
What am I saving right now based on the current situation, and what will change in the next 5 years? Because it's not just the next 12 months we've got to think about, because so many times when we're upsizing our home, we may be going through a stage where we'll change jobs or we'll have a child, start a family. There's so many things that will change in our life over the short term, so we need to factor that in, don't we?
That's right. But I think when people are comfortable with the end mortgage they're going to have, so let's say, you know, you've done your research, you've done your budgeting, and maybe you have spent some time saving the amount of money that's going to be different in your mortgage. I love people to do that first.
Yes.
You know, it's going to be $300 a week more. Let's put $300 a week away.
So they're living that already.
Yeah, put that $300 a week away for the next 6 months and see how that feels before you actually move your family and commit to something, because there'd be nothing worse than doing this changeover and actually having to go back and having the changeover again. But what I really wanted to go across today was, I guess, the process. So how do I do it? I'm comfortable with what I want to buy, but how do I actually do it? So what do I sell first or do I buy first? And I've got a couple of client scenarios that I wanted to share because I think it really illustrates the processes that people have done. So client story one is these clients had a lot of equity in their home. and they wanted a bigger home. They actually wanted a bit of land. They knew that they would be able to sell their home easily. So the home that they had now was, just a really easy turnover property. But what they were looking for was quite unique. So for them, they weren't too worried about selling their home, but they were really worried about finding the right home. So for them, their risk was not finding the right property. So they didn't want to be in a position where they were going to sell their home and not have found the right property yet.
So can I park there for 30 seconds? That's such a big deal for people, but it's not the most important factor, I don't think. Like people hang their hat on, I want a smooth transition from upsizing or from going from this property to that property. I want to just literally move out of this and into that. And they put so much emphasis on that they potentially rush into buying something as a result of that? Do you see
100%. And I think, the overall home that you end up with and the mortgage you end up with is much more important. For these particular clients, though, when everything was put in front of them, they knew the mortgage that they were comfortable with at the end. But something they could do, which is not available in all cases, they could actually afford to hold the mortgage they had now and the purchase price that they were going to have. So they were going to buy a house. Let's say they were buying for $1 million and selling for $800,000. They could actually, and they had a small mortgage on this property, they could actually afford to hold those two for a period of time, or at least be approved to do so.
Yeah.
So it's kind of like a false hold in one way. So they've got the approval. So what we did for these clients was they could actually get the approval to hold the two properties, but they had no intention of doing that.
Right.
They didn't want to hold the two properties, but they had the luxury of being able to get the finance approved as if they were holding the two.
Gotcha. So is that come down to the client's personality in that sense? Because saying that the bank can allow you to do this and you actually wanting to do it are two very different things, aren't they?
Well, the funny thing is they never actually did it. So what they did was they had a loan approved to have the two, but they put a few things in place to make sure that they didn't actually want the two loans at any point in time. So they put a few things in place to mitigate that risk of them having to have the two for a period of time. And what they did was they got the loan approved in the background to hold the two. But then they already had their property getting really ready to be marketed. So they got their conveyancer to produce a contract of sale. It turned out that they actually needed to get a pool certification, and that took weeks. So if they hadn't gone down this process first, they could have been stuck, doing all this stuff. Pool certified, getting the conveyancer to produce the contract. They got the agent kind of ready to go to sell their house, but they had no intention of selling until they found the right property. Then they found the right property. And bought it. But when they bought it, they negotiated a longer settlement period. So it's really important to note that a standard contract might have, let's say, 6 weeks on it. But that doesn't mean that's what you have to have. So these particular clients said to the people selling, look, we're going to give you this offer, but we'd like to have a 12-week settlement. And not everybody would say yes to that, but this particular vendor said, you know what, I'm actually doing the same thing. I'm downsizing, so that is great for me. That's going to allow me the time to find something else. So I'm happy with that 12-week settlement.
So for people sitting in the grandstand, that's not always possible, is it? Because the heat of the market can determine what levers you can pull.
That's right.
Like we know many markets around the country now where the days on market might be like 10 days. So there's so much demand there and so little lack of supply that you've got people banging down the door to buy that particular property in competition against you. So to go in and say, oh, look, I want to negotiate a 120-day settlement, the agent's just going to laugh at you.
Yeah, and depending what the owner's own personal needs are as well, that actually might be attractive
to them. Well, it
them.
could be advantageous, but I suppose what I'm saying is you don't just have the pick of the bunch in a hot market. So if you're in a cool market or even just an even level playing market, then you've got a bit more flexibility.
That's right. But remember they had the loan approved in the background to hold the two.
Yep.
So let's say in this particular case, they actually sold their home within 6 weeks because they were all ready to go, and they organised what's called a simultaneous settlement.
Yes.
So they bought and sold on the same day. They never held those two loans at any point. But let's say the people that they bought off didn't want the longer settlement. Let's say they were competing against another buyer that would have offered a 6-week settlement and the owner wanted 6 weeks. For them, that would have actually meant they would have held those 2 loans for 6 weeks.
Yeah.
So 6 weeks interest on that loan. It's not the end of the world. They were happy with that. But it was just fortuitous for them that with everything that fell into place, they didn't ever need it. So they really just got a loan approved that they never actually used.
Yeah, okay. Which is really comforting, isn't it?
Really comforting. Now, that's not most cases.
No.
These particular clients had the income and the equity to be able to hold the 2. They didn't want to have a mortgage that big, but they could. So that isn't most cases, but that is a case. And if that's available to you, that might be something that you would do if you were upsizing.
So if majority is not that, let's talk a little bit about a simultaneous settlement for a minute, because for a lot of listeners, they might not understand what that is. So as you mentioned, both properties settle on the same day.
Yeah.
How easy is it for stars to align for that to happen?
We actually have a lot of simultaneous settlements.
Right.
But it takes some working out. So in this case in particular, there wouldn't have been a simultaneous settlement had they not pre-organised the longer settlement or the longer exchange period at the start. That 12-week period really enabled them to be able to do that. But simultaneous settlements happen quite regularly if everything can line up. You just have to be able to organise it.
Yeah, so you're essentially saying I'm selling this property on this day, but at the same day, maybe at the same time, I am buying this new property over here. So I need the vendor on the other side and the seller on this side, the purchaser on this side to align and say, are you all okay with that?
That's right. And I think a really important thing to note is all of these things, like the settlement date, they need to be negotiated before you exchange contracts.
Gotcha.
A lot of people exchange contracts and then go back and say, I actually want a longer settlement. Well, it's too late.
Yeah.
You need to talk about the terms of your offer before you actually unconditionally exchange that contract.
So in every state we're different in respect to how do we go about that. So, but conceptually speaking, we've put in an offer on this new property and we might have a 3-day cooling off period or a 5-day cooling off period. So in those 3 or 5 days, or even before we put the offer in, the offer is subject to X, Y, and Z, finance, building and pest, etc., but also negotiated already the fact that it'll be a longer settlement.
That's right. Now, these particular clients, because they had such great equity, so they had their loan was small in comparison to the value of their property, they could have qualified for bridging finance.
Right.
They chose not to take bridging finance because the rate would have been a little bit higher. But if they didn't have the income to service the 2 loans and they still wanted to be able to buy before they sold, they would have had to go down the option of bridging finance. But when their income, because their income was big enough for them not to worry about that, they didn't have to.
Okay, so a lot to take in there.
That's a lot.
We're buying one property, we're selling this existing property that we own, and we're creating a simultaneous settlement where one sells and the other buys or other purchase on the same day. So we need our agents and our vendor and our purchaser all to align with the conveyancers all on the same day. Sounds complicated, but you do plenty of them, which is comforting. If all the stars don't align and we've got varying markets, and you said in this situation the person had a different type of asset that they were buying from what they were selling. So there's another level of detail there, isn't it? Because you could be a completely different market. I had a friend who did this where they're selling what we call a traditional residential house and buying acreage.
Yep.
Right? So you go from beachside to acreage, and they're always different markets. The days on market are very different. The heat of the markets are always different. The negotiation process is different. So you've really got to be wearing 2 hats, don't you?
Yeah, that's right. And they felt very confident because they had one of those properties that were selling with a very quick turnover. Now, if they had a farm, we might have had a very different conversation.
Yes, absolutely. Yeah. All right.
Now, the next scenario I have for you is probably the more common.
All right.
So this is a client who had a property, and it's the figures I use at the start. They had a property that was worth $800,000 and they had a mortgage on that property of about $470,000. So they've got some equity in that property, but not enough to be able to go and buy the $1 million property they wanted and use bridging finance.
Right.
So for bridging finance, you need to have a lot of equity because there's only a certain percentage of the overall that they can do. But they also were really particular about the mortgage they wanted at the end. So they wouldn't have risked buying a property, even if we could have got bridging finance. Let's say they had plenty of equity and we could do a bridge. Again, when you're doing bridging finance, there's a risk because the risk is, what if you buy this house at $1 million, but then you don't sell for the $800 you're expecting to get? Well, then you're going to be left with a mortgage bigger than you intend. And if you've got a budget ready for this mortgage, but then it turns out to be bigger, well, you're in all sorts of trouble.
Big troubles in Little China. Okay, let's take a break. And then when we come back, we'll talk about the downsides of bridging loans.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
All right, so Rach, tell us, in your experience, well, first of all, the concept of a bridging loan, but then the downsides or the negatives of bridging.
Well, the concept of a bridging loan is that the bank actually has control. So the bank says, I'm going to hold the property that you have now. I'm going to refinance the mortgage you've got now, and then I'm going to finance the property that you're buying, and I'm going to hold that property deed as well. So I've got both deeds and I've got both mortgages, and you can buy before you sell, but I'm actually going to make sure you sell this property because you might not need to make the repayments during the bridging process, and that might be, 6 months, or they might even allow 12 months. But what's going to happen at the end is that house has to be sold, and if it didn't sell in that time, we can force that to be sold. And then all of the interest gets capitalised in if you're not making repayments, and then that gets added at the end.
So let's strip that back a bit for the first-time users here. Excuse me, too much pumpkin salad. The first part of that is the bank's got total control over your life right now.
Yeah.
They've got both mortgages or control over all of your lending, and they can pull the lever on it at a stage where you haven't sold that initial property, right? So is that generally a time frame where you say, look, you need to have sold your property within 3 months or 6 months or 12 months?
Some banks it's 6 months, some it's 12 months, but really with a bridging situation, you don't want to be holding them for any sort of period of time. Because generally there's a risk involved. If you're buying at this time, what happens if the market goes down? You've already committed to this property at this level. You're selling over here. What happens if the market goes down?
So this first property that you own that's worth $800, you're now saying in a slowing market in the next 6 months, and we don't know what the future holds, could be now only worth $750.
Yeah.
So bank's okay with that. They take the $750 or like the sale, but you're $50K worse off, which has then impacted you on the other side. How is that $50K then added on if it wasn't factored into in the first place?
Well, then your mortgage at the end is just going to be bigger.
So what if your servicing doesn't suit that new mortgage?
So there wouldn't be a loan approved, a bridging loan approved without all these buffers taken into account. But what the bank will approve and what you've budgeted for are very different.
Very different.
So, you might have budgeted for this mortgage of $500,000 at the end and you're comfortable with that. But if you sold for less, even and the bank's, capitalising that interest in, you might end up with a mortgage of $600,000. Now, yes, you can afford that on the bank's calculators, but that's not what you budgeted for and that's not what you wanted. So I think there's more risk in buying before you sell.
100% there is. And it's a very stressful experience if you're not getting the sale you want in the desired time frame of that first property, especially if the market dips.
Yeah. So, these particular clients, again, they didn't have the option for bridging. If they did, I would have advised them against it because their budget really was, this is the end mortgage we want, and we don't want a mortgage bigger than that. Well, if you're really stuck on that mortgage, the last thing you want to do is go and commit to a property before you sell. So they ended up doing what's called selling before you buy. Now, what they did, this is the process. If you want to sell and then buy, it doesn't necessarily mean you have to move your family twice. It just means you have to be prepared to do that if the stars don't align. So what they did was they got a pre-approval. So the pre-approval is, okay, when I sell my house for $800,000, I've got a contract exchanged and I've got, a period of settlement before that happens. I've got an approval to go and buy the next house. And that's my end mortgage is going to be $750,000, let's say. So I've already got a pre-approval here for $750,000. So you have all of your ducks in a row before you sell your house.
Gotcha.
Everything's ready to go. So the moment that someone exchanges on your property, you can go and look. Now, when you're selling a house, now in that first scenario where the buyer negotiated a longer settlement period because the standard was 6 weeks, these particular clients had control. Because they were creating, when you go to your conveyancer and say, can you please create a contract of sale for me to sell my house, they actually said, I want a 12-week settlement. So in the contract of sale, they put a 12-week settlement. Coincidence, they were both 12. But they said, I want to have a 12-week settlement. That way, when somebody buys my house, I've got 12 weeks. I've got 12 weeks to go and find another property. Because I can't go and buy something before someone's actually exchanged and gone into an unconditional contract on my house.
All right, so we've got 3 scenarios here. We've got the first one of I sell my property and I buy another one and I have a simultaneous settlement, as in I buy one and sell one on the same day.
Yep.
There's more stress involved than that, but it's busy enough, isn't it? It's we're trying to do 2 things at once, essentially. The second scenario of I've got my property, I sell it, and then I've got some time up my sleeve to go and buy another one, but it's still a finite time frame.
That's right.
12
weeks is still a lot. So 12 weeks is a lot of time, but it's not really a lot because the one that you go and buy is still going to have a 6-week, depending on the state, but let's say it's 6 weeks. So they ended up selling their property from the moment they exchanged. They already had their finance ready. Everything's ready to go. It only took them 4 weeks to find a property.
Right.
And it had a 6-week settlement. So really the one they were going to buy the one that they were going to buy was going to settle 2 weeks later, but they organised a simultaneous settlement because remember, they have control.
Yeah.
Before they bought this other property, they said, okay, we actually want 2 weeks more.
Yeah, yeah. So then the third option is I take a bridging loan, I buy something first, and then hope to hell my first property sells in a desired time frame where I'm not impacted.
Yeah. Now, for these particular clients, it all worked out and they also had a simultaneous settlement. But let's say it didn't. So let's say what was the risk to these clients? And I think this is the really important part.
Yes.
If you're selling before you buy, when we sat down and work out what their risk is, what's the worst case scenario? You've sold before you bought. You're not going to, you don't find the property. They did, but there's many people that don't. What's your plan B? Let's have that in place. Are you moving in with family? Are you getting an Airbnb? Can you put your stuff in storage? And that was the plan they had. But for most people, having to move into their parents' house for 6 weeks is a lot less risky than having to get stuck with a much bigger mortgage because they've bought before they sold.
So they've bought before they sold, but they can still move into that property that they've bought?
No, they can still move into that property they bought. No, so what if they didn't find a property?
Okay, but the bridging loan is for when?
The bridging, if you got bridging approved,
yes,
that's when you can move in and you've got the 2 properties for a period of time.
Yes.
And you can market the other one at your leisure once you've already moved in.
Yeah.
But you've got that risk involved of you don't know what that house is going to sell for and you don't really know what your mortgage is going to be at the end of the day.
Okay, so let's park there for a little bit and say, right, I bought this property, I move into that property, it settles. All is well and good, but hang on a minute, I haven't sold this previous asset here. Now I've got to get on my skates and sell that property for a desired price. Otherwise, it's going to be impacted on my mortgage on the other side.
That's right.
Right. So what are the impacts? Like the banks don't do this stuff for free. So what's the premium that the customer's paying for a bridging loan?
So if you get a standard bridging loan with most of the banks, you're paying a premium because you're paying, let's say their standard variable rate, which is what a lot of them do. So let's say your rate today might be 6% for a home loan, but the bridging rate might be the standard variable, which can be 2% higher.
Right, so 8%.
So, but that's the cost. It's the cost of holding the two and the bank having control. Now, we have a lot of people that would come and ask us for bridging loans, but I would say there's a whole lot less that actually walk away with one.
Right.
Generally, there's another alternative, and that's why I thought I wanted to talk about some of these other alternatives because in this case, even if you could get bridging approved, it would not be recommended because really that mortgage at the end is important to you. Very different if you're a person without a mortgage and you're downsizing. And I feel like traditionally that's what bridging is designed for. It's really designed for the people who are downsizing and maybe not going to have a mortgage at the end of the day.
So the banks out there promoting these bridging loans?
I don't think so. No, I don't think. I think they have it there in their suite, but I don't think there's different businesses that just do bridging loans.
Yeah.
They might come with a whole lot of different fees though. Yeah,
because in the ideal world, like it's what sort of stress you want to put yourself under.
That's
as well,
right.
isn't it? Like, because you got to live a life. You might have kids. You might be working 50, 60 hours a week, you got other stuff going on in your life, and all of a sudden you're trying to buy and sell at the same time. Like in an ideal world, you'd say, right, I sell this property. I know what's actually in the bank. The money's settled. It's sitting there. I've maybe done a little bit of searching. I know what I want, but now once the money's there, I go and do that searching and then buy something within the next sort of 3 to 6 months. Where people, I suppose, vary from that is there's this gap in between. It's like, where do I live?
Yeah.
Is that fair to say that's the biggest concern?
And I think most people, their biggest concern at the start of that process is not wanting to move my family twice or not having somewhere to live.
Yes.
But when you actually really outline the risks of both scenarios, both ways, well, the risks on buying first tend to be a lot more.
Higher,
a lot more. And it can be a really scary place. So I would say most people would sell before they buy, but then a lot of people don't understand. If you've never done it before, you don't understand that you can do things like have a longer settlement period, and you control that as the owner. You put it in your contract of sale and say, I want a 12-week standard settlement. You can have it anything you like. Yeah. You dictate when you're selling the property what the settlement period is.
Yeah.
So you can buy yourself time.
Absolutely. And my 2 cents worth opinion on this, because we're entitled to an opinion on this show, is don't let that short period of your life, that 3 months or 6 months where you have to find out where you're going to live and move the family twice and all that, don't let that be the barrier that stops you from doing things in a logical order.
Yeah. That is, a logical order is the perfect way to describe it.
Because it's just fraught with danger from a dollar's point of view, but also a stress level point of view.
Yeah.
I'm sure people are listening in now thinking, hell do I want to go through that process? Like, I just can't even get my head around one purchase, let alone trying to navigate the way through two at the same time and deal with different agents and which conveyance am I talking to now? Is it the one I'm selling or one I'm buying, or what am I doing here? Like, it's just a lot to put yourself through.
And you can do a lot at the start. When you start the process, you can do a lot to sort of like reduce a lot of the risks that you have, which is longer settlement periods, making sure in that first scenario, making sure their house was completely ready beforehand. Imagine if they'd gone and bought that house, but then they started the process of getting an agent and getting their contract of sale ready. And then they found out their pool wasn't certified. Well, that was a 10-week wait. Imagine that. So it's just you can have all of your ducks in a row, which either way you go, to make sure that you've covered everything before you start.
You can pivot, and the business owner side of me comes out and saying, well, if you are going to be up for this and put your life through it, finance-wise, you've done the maths. You maybe, if you're a partnership, husband and wife or whatever, you've got a partner there, you might say, right, one of us focus on the sale and one of us focus on the purchase, but align with what we're agreeing on both sides. And it's like, go off and do our own thing to get it done. I mean, it's just there's a lot going on, isn't there? But
there is.
You mentioned the settlement and we can be flexible with the settlement timeframes. Well, in theory we can, but again, really dependent on the market that we're dealing with,
at
because sometimes that's not possible. And we'd like to think, we can extend to 90 days and 120 days and people out there might want that. But the property you want, because we're talking about upsizer, our dream home, really, aren't we? So that property that we really want is in a hot market, and the vendor says, well, no, these owners want a 30-day settlement, and I know they're going to get that because it's a hot market. So you offering 120 is just not going to fly.
100%. Now, in that first scenario where we had the loan approved in the background to be able to buy the two, now if the person who was selling the property had said 6 weeks or nothing, well, we'd already done the numbers on that. It was going to cost them about $4,000 in extra interest to hold those two for 6 weeks. Yeah. So do they want to get the 12 weeks and save themselves $4,000? Absolutely. But would they have cost themselves their dream home for $4,000?
No.
So it's about knowing all of those. What's it going to cost me to hold the two? $4,000? I'd love to do that.
Yeah. It just comes to me back to having a great mortgage broker in your corner to navigate you through the scenario.
Yeah, and I think, but if I could give, when people say to me, is bridging worth it? I generally say no. Yeah. I generally say bridging is like it's for very few. It's for very few that it actually suits. But I think a lot of people, what they think of bridging, it isn't actually bridging. It's holding the two.
Holding the two, yeah, without paying the penalty of the extra 2% interest.
Or having the bank have control.
Yeah, and that's the other thing, isn't it? So I've heard of scenarios where the bridging loan has cost someone an extra 50, 100, 150K.
So have I.
Right? Is that because not so much the fees from the bank, but the fact that they got less for their property that they were selling, or how does that work?
So here's something that I've seen happen. So I've seen this happen with a bridging scenario. So the agent had gone out and told this client that they were going to get, and I can't remember the figures, let's say it's $1 million for their house, and they've gone and bought another house for $2 million, thinking that the agent said they will get $1 million, no worries for their property. So they thought, that's really safe. I'm really happy with these numbers. I've got my bridging loan approved and I've gone and got that next property. Well, the marketing process starts and they're paying interest on the two.
Yes.
And then offers come in at 800. And they go, that's not what we budgeted for.
Holy hell.
Holy hell. What do we do? And you've got a choice then. And I always hear real estate agents say you get the best offer in the first 30 days on the market, because the people who, are buying your house are already looking, but they kept waiting. They didn't get their number that the agent had told them this figure and they didn't get it, so they kept waiting. Ooh. But while they were waiting, interest is capitalising up. Well, they ended up selling for 800, but they ended up selling for 800 9 months later.
Right.
So they also had... so it's $200,000 less than they budgeted for on their end loan. But I think there was something like $80,000 in interest. So if they'd taken that $800 at the start of the process, it would have been very different. Yeah. But again, when you see these kind of big numbers, that's like $280,000 more on their mortgage at the end than they had budgeted for. Really getting an Airbnb for a few weeks because you're selling before you buy doesn't seem that big a risk anymore.
No. So the real actual cost is 280, but the actual out of pocket because of the bridging is 80. Like the 200s because the real estate agent fluffed them into thinking it was worth $1 million when it wasn't.
And generally, if somebody was coming, if you go to a mortgage broker and say, this is what I'm planning on doing, and the agent's told me I'm going to sell for this, well, generally they would get a bank valuation done. And I always say to people, take the bank valuation over the real estate valuation. It's really important to note that a valuer is qualified to value property. A real estate agent is qualified to market property.
Yeah, and that's a really good point, Rach, because not a lot of vendors think to get an independent valuation, because obviously it costs money, $500-$600 when I last checked, to go and get that done before they list their property, because that's a realistic view. They're not looking to sell the property, the valuer. They're just coming in to do a job and perform a valuation on the property.
Your mortgage broker should be able to get that done for you without a cost.
As an independent val?
A bank valuation.
A bank val, right. So if they're not going with that bank, then the valuation from another lender may be different?
I don't think it matters what bank you go with. The bank, to get the business, the bank is giving the broker access to their valuation team for free.
Would you get – okay, so that's a good point. So you can get a bank valuation done through your mortgage broker at no cost, and if you're paying for that through your mortgage broker, something's going wrong there. But an independent val is a step further, isn't it? Is to say, well, I can get an independent valuer who's not aligned, that's recruited by the banks, that's independent. So nothing to do with my mortgage that I've got with the bank right now.
I don't understand why you go and pay for an independent valuer when, so let's say you've got a bank here that has that same value on their panel, which most of them do. They're all the same. Why would you not have the bank pay for it rather than you go and pay for them yourself?
You could, but I'm just saying another layer of due diligence.
You could, yes.
Because you're going through that period where you need to make sure you know what it's worth here and not just have the real estate agent give you some figure that's not realistic.
100%. And if you're looking at getting, if you're looking at options of whether you could buy or hold the two, the broker's going to be doing valuations anyway, and they might be doing multiple for you. So they actually might be doing evaluations with two different banks because that could actually impact the bank that you choose.
Totally. Absolutely. No, that's awesome. Okay, so that's been really good to thrash that out. Is there any sort of, final notes or thoughts on which way we're going with that? Or not which way we're going, but for the listeners out there that are saying, well, I've got my own home now. I'm wanting to be upsizing in a few years' time potentially. What are my key takeaways?
I think if you want to upsize, it would be about sitting down with a mortgage broker before you're doing anything and work out the different scenarios and what's available to you. And if they say, if the broker's saying it's things like buying before you sell is a risk, really listen because they're not trying to scare you. It is, they're real things that can happen. So it's just nice to know what risk level you're comfortable with before you're going down that road.
Absolutely. No, I love that. Keep your cash buffers high. You've got to, cash is king, isn't it, in these situations where you may need to put a little bit more in because the time frames blew out a little bit.
Yeah, that's right. And there is a third way that you can go, which is if you have the 10% deposit ready, you can go and exchange on a property and then sell yours. And people do this, which is where they go, okay, I'm going to go and buy a property and get an extended settlement period. And we have clients come to us and they've said, I've just gone and paid 10% at auction and I'm meeting you now for the first time. So they've said, hi, this is our first meeting. I've just gone and paid my 10% at auction. This house of my dreams came up. I've done nothing. But what I did do was organise, a 10-week settlement, before I put my hand up. Well, they've got to sell quickly or they've got to have the loan approved. But people do that all the time. But if you have the 10%, you can go and exchange on that property and just know that you have to sell in time. Now, that would be the riskiest of all because you're actually risking that whole 10%.
Totally.
But you would be surprised at how many people do that and call us after that period.
Crazy.
They've bought a house already.
Yeah, not in my wheelhouse. It wouldn't be something
not recommended.
I'd be doing. No, well, not personally or recommendation, but it's obviously done out there, and I suppose in finishing, you've got people around you in your life that may be able to assist with that too. Like you're experts in your corner, but there may be mum or dad or Auntie June who has this war chest of funds that might be just a quick get out clause in the meantime as well. So use the resources as you need to with that as well. So
yeah, that's right.
All right, very good, Rach. That was well explained. It was a really good exercise to go through those scenarios to know that what's possible for you when you're upsizing your home.
What would you say? Bridging, is it worth it?
Bridging, is it worth it? I would say no. What would you say?
I would say no.
Yeah, for two reasons. Physically, the dollar value that could go down the drain, never to recover, and the mental stress and load that you put on you and your family or you as an individual, just not worth it in my book.
Agreed.
All right, well, if you like what you hear today, go on and give us a sneaky 5-star review or send it to family and friends. Much appreciated. As always, look forward to chatting again soon. I'm John and this is Rachel and this is Property.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.